Japan just broke the global economy. Introduction. In early 2025, a seismic shift reverberated through the global economic landscape. Japan, long considered a stable and vital pillar of the international financial system, slipped into a technical recession and lost its position as the world's third largest economy. Germany overtook Japan in nominal GDP, while India rapidly approaches in fourth place. This event, more than a mere shuffle in global rankings, has ignited fears of a wider economic fallout. The ripple effects of Japan's downturn are being felt in international markets, foreign exchange, global supply chains, and geopolitical strategies. This article explores how Japan's current economic crisis is not just a national issue, but a global disruption, a break in the economic framework that has stood for decades. The fall from third to fourth, a historic shift. For decades, Japan has occupied the third spot in the global economy, trailing only behind the United States and China. Its cutting-edge technology sector, automotive industry, and disciplined workforce created a strong, export-driven model admired worldwide. But in 2024, Japan's nominal GDP fell to approximately $4.2 trillion USD, while Germany's rose to $4.4 trillion, pushing Japan into fourth place for the first time since the early 1990s. This shift was more than symbolic. Japan losing its top-tier ranking calls into question the durability of its economic model and exposes long-standing vulnerabilities, including deflation, demographic decline, and fiscal stagnation that were ignored or underestimated for years. The numbers behind the crisis. Japan's economy shrank by 0.4% in the last quarter of 2023, following a 3.3% contraction in the previous quarter. These back-to-back contractions meet the technical definition of a recession. Consumer spending, which accounts for over half of the Japanese economy, declined as inflation bit into household budgets and wages stagnated. Moreover, Japan's GDP drop was exacerbated by the sharp depreciation of the yen. Once considered a safe haven currency, the yen has weakened dramatically against the US dollar, falling to multi-decade lows. This has inflated import costs, particularly for energy and raw materials, worsening the cost of living crisis and putting further strain on businesses and consumers. #yen in crisis. The Japanese yen has been in free fall, declining more than 30% against the US dollar over the past 2 years. The causes are complex, but they center around Japan's ultra-loose monetary policy. While most developed nations, particularly the US, have been aggressively raising interest rates to combat inflation, the Bank of Japan, BOJ, has maintained near zero or even negative rates. This divergence in monetary policy has created a carry trade boom, where investors borrow yen at low rates and invest in higher-yielding assets abroad. The result? A downward spiral in the yen's value and increasing vulnerability in Japan's financial position. This currency weakness makes Japanese exports cheaper, but it also raises the price of imports, particularly devastating for a resource-scarce nation like Japan. Inflation, once elusive in the Japanese economy, has returned with a vengeance, but not in the form policymakers had hoped. It's cost-push inflation, driven by a weak yen and higher import prices, not by strong domestic demand. Japan loses its crown as top creditor nation. In 2024, Japan lost another symbolic but economically significant title, the world's largest creditor nation, to Germany. Japan had held this position for 34 consecutive years. Net external assets, a measure of a country's assets and liabilities abroad, stood at $533 trillion, $3.7 trillion for Japan, but Germany surged past with assets totaling $569 trillion. This changing of the guard is more than just bragging rights. It indicates declining Japanese capital surpluses and waning overseas influence. Japan's position as a major financier of global infrastructure and government debt is now in question, particularly in developing nations that have relied on Japanese loans and investment. The demographic time bomb. Behind all these economic headlines lies Japan's most chronic and existential challenge: its aging and shrinking population. Japan has one of the oldest populations in the world, with nearly 30% of its citizens aged 65 and over. Birth rates have plummeted to historic lows, and immigration policies remain restrictive compared to other advanced economies. This demographic crunch affects everything. The workforce is contracting, public pension and healthcare costs are ballooning, And domestic consumption, long seen as a potential counterweight to export reliance, continues to weaken. Unlike younger nations, Japan doesn't have a growing base of consumers or workers to help drive growth or innovation. The impact on productivity, economic dynamism, and social cohesion is immense. Labor shortages are beginning to hit not just in low-wage sectors like agriculture and caregiving, but also in skilled areas like engineering, manufacturing, and R&D. With fewer working-age people, sustaining economic growth becomes increasingly difficult. Global supply chains and Japan's strategic role. Japan plays a critical role in global supply chains, particularly in the production of semiconductors, electronics components, automotive parts, and precision machinery. Its economic slowdown and currency instability threaten to disrupt the smooth operation of these supply chains, potentially driving up costs and slowing down production in other economies. For example, Japanese firms like Renesas, Sony, and Toshiba are key suppliers of specialized chips used in everything from vehicles to smartphones. In the automotive industry, Toyota and Honda operate complex networks of suppliers and subsidiaries that span the globe. If the Japanese economy falters further, production delays and component shortages could ripple across Asia, North America, and Europe. Moreover, Japan's retreat from global investment activity could open the door for Chinese expansion in key strategic sectors across Southeast Asia and Africa, challenging the US and European influence in these regions. What this means for the global economy. Japan's downturn isn't just a domestic affair. Here's how it affects the global economy. 1. Currency volatility. A weak yen contributes to currency volatility across Asia. Nations like South Korea, Taiwan, and China are forced to consider defensive measures to protect their own export competitiveness, which can lead to a regional currency war. 2. Investor sentiment. Japan's recession feeds fears of a global economic slowdown. The Nikkei and other Japanese indices have seen fluctuations, causing ripple effects in global markets, especially in Asia-focused ETFs and funds. 3. Central bank divergence. Japan's dovish stance on interest rates contrasts sharply with hawkish policies in the US and Europe, complicating global financial coordination. It also encourages risky carry trades, which could unwind violently